In just a few short days in his testimony to the Senate Banking Committee, Jerome Powell was able to retire the word transitory. He indicated that the Federal Reserve may discuss speeding up its bond tapering program, and he sent markets absolutely wild. We're going to discuss what all this means, what it means to you as a Canadian, because of course we're talking about the Federal Reserve Bank here, and how you should plan for it going forward. The definitive guide on how to manage your credit: product, penalty, price, in that order. It's never been more important to get your mortgage right. Okay, so the Federal Reserve Board seemingly flip-flopped this week and went from an expectation that they were going to increase rates later on in the year and that they were going to continue with their slow movements with respect to increasing interest rates and slowing down their bond buying program, to all of a sudden it's seeming as though they're going to do that significantly faster. And I'm going to discuss what all this means, what it means to you as a Canadian, and why this is so important. But before we get into it, do me that favor, hit that subscribe button, hit that notification bell, please hit that like button so more people like you can see this video. And don't forget about our race to 25,000 subscribers, where one lucky winner is going to win $5,000 just for subscribing to this channel. But in order to win, you have to be subscribed. So it's free, it's easy, it's definitely worth it. Go ahead, click that subscribe button, and let's discuss Jerome Powell and what this means for Canada. So first and foremost, let's talk about what happened here. Jerome Powell, just for some background information, he was renominated to be the chair of the Federal Reserve Bank in the US this week by President Joe Biden for another 4-year period. Now, that may have something to do with why his tone is changing with respect to interest rates and with respect to the bond buying program. It may have been indicated to him that he should perhaps, go ahead and give the market some more comfort with respect to inflation and whatnot, although the Federal Reserve Bank is supposed to act independently from the federal government. So maybe that didn't happen. Who knows what happened behind the scenes? But it's interesting that a couple of days after he is renominated, his tone seemingly changes. Now, here's the thing though, did it actually change? So we're going to talk about all of that, but let's start first by showing you a little bit of the news here and showing you what's going on across the market with respect to how his remarks are being interpreted. So first of all, Powell says time to retire transitory when talking about inflation, and the stock markets subsequently tank. So if you weren't watching the markets today, obviously they went down almost 2% across the board, whether it was the Dow or the NASDAQ or the TSX. Obviously, we saw last week similar things happen when the Omicron variant of COVID basically became what do they call it? It became a variant of concern. That's something like that. Anyways, whatever they call it, whatever the WHO called it, we did a video on that previously. It's escaping me at the moment, but yeah, basically last Friday this happened. We saw a major downturn in the stock market as a result of that. And, it's really interesting because basically all this took was Jerome Powell saying transitory is a word that we need to retire, and we're going to relook at our strategy going forward, which are things that we probably could have predicted that he was going to do. Now, here's the thing about transitory. Actually, we probably couldn't predict that he was going to walk back the term transitory, but he's very clear in the fact that this has caused a lot of confusion. So it's been confused a lot with the word temporary. We've done previous videos on this, where a temporary rise in inflation is one where prices go up and then they come back down. And that is what many people weren't interpreting transitory to mean, but that isn't what it means. What it means is that there's an effect on inflation, and inflation goes up and therefore prices go up. And then the transitory effects, the things that are causing inflation to go up, they tend to go away, but the prices still remain the same, and then normal inflation takes place after that. So they expected to see a jump in prices of 4 or 5%. Some economists are now predicting that it's going to be 7%. And this has just created a whole bunch of chaos and a whole bunch of confusion in the market. So he's saying, let's get rid of the word transitory. We're past that. And going forward, we're never going to say that word again. So maybe we'll say it again on this channel. Maybe we won't, but we're going to try not to use it because, again, it's confusing. The gist of it, though, is this, that the increases in prices that have happened are here to stay. And what they're hoping is the supply side effects that cause them are eventually going to go away. Now, next thing that he talked about with respect to inflation and what's going on is he talked about an earlier end to bond tapering. So just 4 weeks ago, they suggested that they were going to put an 8-month bond tapering program into place. This would essentially end bond buying program, the excessive bond buying program of the Federal Reserve, by about June. That also coincidentally was when the market was pricing in the first rate hike from the Federal Reserve. Now, as of Friday, when the Omicron crisis hit us, that was pushed back to basically September. So the markets basically guess what's going to happen, and their guess moved from the first increase coming in June to it coming in September. And then things kind of got a little bit better on Monday. And today, with respect to the conversation that Jerome Powell has been having over the last 2 days with respect to moving up that bond tapering program, that therefore moved the predictions back to June. So in the last 3 days, we've seen Omicron become a major news story. We saw a fall in the Dow. We saw the expectation of rate increases pushed back. And then on Tuesday, we saw Jerome Powell talk about transitory and bond tapering, and that moved it back forward. So compared to where we were on Thursday of last week, we are essentially in the exact same place from a economics perspective and from the perspective of when we can expect higher interest rates. Now, to show you this, I just want to take you in here and I want to show you the 5-year Canada government bond yield. If we go back 5 days, we can see this is where the market corrected and we saw bond yields come down quite substantially. That was when COVID became a news story again. And as you can see, since Friday, we have pretty much seen bond markets remain flat, which means the market is pricing in the same expectations as they had on Friday. So, really interesting numbers here. I had one more article from Barron's where Powell changed his tone, not his game, time to stop panicking. That's what we're talking about right now, is he has essentially changed his tone with respect to transitory. He has changed his tone with respect to when the bond tapering is going to happen, but he hasn't changed his game plan. His game plan still seems to be that he wants to make sure that jobs are back to normal prior to actually making any sort of rate increases. Now, he did indicate that inflation is a significantly more important issue than jobs, because if inflation becomes something that has a long-term effect and it is something that's not under control by middle of next year, well, that could have a negative effect on jobs as well. And therefore, it's something that they have to pay attention to. So what all this means is simply this. Nothing's changed really with respect to what the expectations are in the US. They may move their bond buying program up a little bit, or the tapering of their bond buying program up a little bit. But what we need to do is just wait and see what happens in that December 15th meeting when the Federal Reserve actually discusses this and then releases a new statement based on what they're planning on doing. Now, as far as Canada goes, well, Bank of Canada has been a little bit ahead of the Federal Reserve with respect to their expectations on the economy and when they're going to move interest rates up. Obviously, the Omicron issues have an effect where they could potentially move back the amount of time it takes in order for us to have interest rate increases. But with the Federal Reserve essentially saying they're going to start tapering sooner, that could actually bring forward the amount of time that would take for Canada to increase its interest rates if they're aiming to do it just prior to the Federal Reserve in the US. So, a lot of interesting things happening here. The one thing that we always see around these types of times is we see people going, well, I hear interest rates are going up. I hear that I should be locking in because interest rates are going up. And the reality is, as of right now, we don't really know what's happening. What we do know is what our variable mortgages are priced at, what our fixed rate mortgages are priced at. And we can therefore look at the difference between those, see how much money it would save us to be in a variable versus a fixed. On a monthly basis, we can calculate the difference between the payments, the higher payments for a fixed rate mortgage, the difference, and that higher payment amount can be considered insurance against rising interest rates. And then you just have to make a decision on whether or not you want to pay that insurance to the bank and also have the risk of a higher penalty in exchange for some security on interest rates. Now, with respect to where the market is predicting rates will go over the next 2 years, the market is predicting 5 interest rate increases. Now, we see that the Scotiabank economists are saying that they're expecting 8 increases. We see Manulife's economists saying they expect 2. Obviously, it's probably going to fall somewhere in the middle of that, and the market is indicating 5. So if you can get a variable rate right now for 1% lower than what you would get a fixed rate mortgage, well, even if interest rates go up 5 times or 1.25%, you're still going to be winning on a variable rate mortgage because you have all the time that you spend at 1% lower than 0.75% lower than 0.5% lower than 0.25% lower, and then at the exact same interest rate. And even if you have one more interest rate increase above what the 5-year fixed mortgage that you could have got was, or 2 or 3 or 4, well, you're still going to be saving because you've got all of that time where you've saved money in the meantime. So, that this conversation, the transitory thing being a word that we want to retire. All of that hasn't changed our strategy. What is important to realize about media and news, and even this channel, think about this channel. You look at the thumbnails and the titles in my descriptions, and they are red, they're bright, they have shocked faces, and they have headlines that are designed to get you to watch. And the only reason that they're done that way is just because, just like in the news, in order to get people to watch the video or in order to get people to read the news, you have to kind of have a little bit of a sensational title, and you have to have them want to click in and actually see what you have to say. So one of the things that I've taken and done with this channel is I've said, okay, I'll play the news game of making the thumbnails and the titles descriptive and things that you want to click on. Maybe they're a little bit shocking, but then when we actually get into the videos, like on this one, we actually talk about the realities of what's going to happen. We talk about what you should know, what you need to know, and we don't necessarily put a negative spin on everything when things aren't necessarily negative. Because the stock market indicated today with a 2% drop that this new conversation that Jerome Powell is having could be one that would ultimately affect the markets and ultimately affect them in a negative way. But at the end of the day, when we actually look at the data and we look at what's happened over the last 5 days, it's probably a whole lot of non-news until we actually see interest rates start to go up sometime in 2022. So if you found this video useful, do me that favor, hit that subscribe button, hit that notification bell. Please hit that like button so more people like you can see this video. Don't forget about our race to 25,000 subscribers, and we'll see you on the very next one. Cheers.